I was talking about the first money market instrument called call money, the call market. It's a very short term market, but three kinds of money change hand there: call money, notice money, term money. And I was talking about that how this money market has now presently two interest rates, which are called call rates. One is the interbank call rate, other one is the DFHI call rate, the lending rate, and there is one more which many people do not know. There is an unorganized banking sector in India which is in existence for the last 150 to 200 years maybe, and this in some pockets of India. There are some banks in Tamil Nadu, there are some such banks in Gujarat. They also have a call rate, they help each other out, but we don't have any, I don't have any information on those call rates. Now, the thing is, if you look at the call money data, you realize that you can have a daily data. At the end of the day, what was the call rate? You can have a monthly data, and you can have an average annual data. Now, I have both monthly data and average annual data for you. I will show that to you. And it's very interesting, doesn't happen much these days. The call money definitely has significant fluctuation from month to month. It has. Now, some people refer to that in economics as a variable having seasonal fluctuations. For instance, if you go into the agricultural cropping pattern in India, you will see some seasonal fluctuations are there, which otherwise does not exist in some months. Like farmers spending on seeds and fertilizer, definite lines are there. It surges in some months during the sowing season and post sowing season, and then it takes about 4 months the rice to grow or the paddy or whatever to grow the crop, and then the harvest time, and then it dies off. Now, this seasonal pattern you can observe if you have only if you have monthly data, because then month wise if you plot numbers, then you will see some months showing exceptional behavior. Now, call money it is said that call money has seasonal fluctuations, and these fluctuations they have tried to identify some of the reasons. One, that there is a very short term fluctuation, sometimes end of the week it is high, because end of the week banks are supposed to show the CRR. So, they do borrow in the call market a lot, say Friday. Then when the tax payments come, there are some advanced tax payments which can be made in say mid of the year June, then in December, and finally in March. During the tax payment times, the call money shows some, like the demand is more than supply, because companies are withdrawing cash from the banks and making the tax payments. So, banks experience more than unusual withdrawal amounts, and there is a pressure on the call market. Advanced tax payments get done. Then it is also said when government introduces a new bill, a law, because government wants money, often the banks etc. and non-banks invest, because it is a very safe investment. And I do not know whether you know this or not, banks are not supposed to invest in the capital market. Banks cannot invest in the capital market, remember, because it is a risky market. Securities market, industrial securities market, banks cannot invest by law, because you cannot fool around, you cannot play around, you cannot speculate with public money, people's money which is there with you, by investing in very risky markets like share markets. So, now what do banks, where do banks invest then to make some money, some income? They often go for the gilt-edge market, the government market. The government bills market is safe. So, if government now floats a bill, crores and thousands of crores of rupees it is borrowing, all right, banks, etc., non-banks who have surplus cash go and invest, there can be a shortening of liquidity in the call market, and the call rate would immediately shoot up. All right. So, this is another reason which has been said. And then of course, depending upon the economic cycles within a year or across years, if the economy is doing well, there will be a lot of cash getting deposited in the bank. If the economy is not doing well, a lot of cash is not getting deposited in the bank. Very simple. So, with economic cycles, call money can also go through a cycle. All right, because call money is after all banks borrowing from other banks primarily. The banks will be flush with funds if the economy is growing at 10%. Bank is not flush with funds if the economy is growing at a 6%. The call market will show that maybe. And therefore, with this economic cycles, we also know that the stock market goes through a cycle. All right. So, if you say that there is a competing investment going on with banks and also in the stock market, then the stock market investments activities can also influence deposits in banks and therefore also can influence the call market. Who knows which way it will go. And another reason which is often cited is during the festive season, often call rates shoot up, because people do in a country, religious country like India, Eid aa raha hai, whole night Lucknow mein shops khola tha, TV mein bata rahe the, you Eid gaya, whole night shops were open, people are buying and buying and buying. This is not normal. Or Dasera aa raha hai, huge amount of purchase goes on, shops are open late, shops are open even on Sundays. So, during these times, festive season, etc., you can also feel that the call market is responding. It may not, it may. So, there can be a variety of factors which can influence the seasonal pattern of call rate. Remember, I will show you the data, we will discuss the data later. Now, this is all I have for you about the call rate. Now, I am going to another very important money market instrument. Call rate is never fixed, is market determined. That was the 1980 tak, because the call rate shot up to 30% and the banking association said, this is nonsense. At 30%, which bank would borrow and which bank would survive after borrowing? So, they put an upper limit on the call market rate. But then from late 1980s, they have decentralized it. It is market determined again. Read Bhole's book, you will get all these points. All right. Now, I come to commercial paper. It's market determined call rate. Commercial paper is a new instrument, relatively new money market instrument in India. Let me talk about that. Commercial paper. It's a new money market instrument, relatively new. They are known in abbreviated terms to the money market participants as CP. I used to know CP for a different thing. I used to know CP. CP is very famous to us who are from Calcutta. You know that. Huh? No, Communist Party, Calcutta Police. All Calcutta police vans at the back had CP and an arrow. Have you noticed that? Go to Calcutta, you will see that. So, I used to know CP for a different reason. But here in the money market context, CP means commercial paper. They use abbreviated terms all the time, particularly these days. It's very fashionable to use abbreviated terms. All right. Now, they were launched in India only in January 1990. Imagine, 22 years old only. Call market is there since 60. This is from 1990 or maybe before that call market existed. 1990, it's very new, very recent commercial papers. They are short term money market, of course, money market instruments are all short term, less than 1 year, and there is a three-word description of a CP. The three-word description of a CP, which is also true for some other money market instruments, they are known as usance, promissory notes. Three-word description of CP, which is common, this kind of a language in this kind of a subject. Usance promissory notes. What they mean is like I am trying to teach you law or something, it sounds like. Usance means time. That means it would mature over time and the time period is mentioned, like a bond. Share is not a usance promissory note. Note is anything which carries a promise to pay something. We usually use the word note for currency, paper currency. Note kitna hai? Which actually, if you read the paper currency, it is written, it promises to pay you something. All right? So, note is now, try to put note in any context wherever something like a bond paper is a note, because it promises to pay you something, and promissory is, of course, you understand which promises. So, it is like a bond in some sense. CP is like a bond, and this is a usance promissory note. All right. To do what? Well, if you are in the corporate world, you know CP very well. And here comes a very interesting thing I am adding to the existing definitions I have used. I told you earlier, the corporate world has the following sources of finance. The word finance is relevant. It can go to the share market, sell shares. It can go to the bond market, sell debentures. It can go to the bank, take credit, loan, the old fashioned business dealings. Even the corporate world can do that, in fact it does. Now, it can go to the market, and in addition to shares, it can sell CPs to get not long term finance, but to get short term finance. Here you see that the corporate world, which operates in the capital market, has now entered your money market by selling CP, because it is short term. So, why do they need short term cash? The reason is the corporate world or the non-corporate business world, any world, requires what is known as working capital. And what is working capital? What is working capital? When a company is run, you know how it is run. The company has a production plan. It assembles the sufficient supply of inputs, raw material, including labor. Then it plans how much output they will produce per day, given a target output maybe. At the end of the month, we need this amount of output. It arranges for the finances to do that, fund that. And then it starts selling that output, and often that sell has a notorious feature. It is a sell kind of with a future payment. So, it is not that a retail market, the way you go to a shop to buy a Coke and you say, ye le lijiye 10 rupiya ek bottle Coke de dijiye. Cash transaction is immediate. In the company business world, often these transactions are deferred payments. The payment will come later. So, the raw material supplier has the same problem when they supply raw material to a company, the payment may come later, and the finished goods supplier also sometimes have the same problem, where you have sold the thing, but the money does not come. The problem with this is that your production is a continuous process and your selling is also a continuous process, but the payments are not continuous often, they are very discontinuous. So, now if you are producing something, you have to make certain payments regularly, electricity bill, some taxes. Most importantly, the wages of the workers. If you do not pay salary, which is happening with Kingfisher, they are in big trouble. Often they are threatening strikes, lockouts, all right, and then also resignations, they leave. Now, skilled labor is very valuable thing. You just cannot leave and the company would still keep on running. Often in modern companies, you require highly skilled labor, like airlines, you require pilots, air hostesses, maintenance staff, they are all specialized. They have gone through training, they have degrees, pilots have licenses also, and you just cannot say, wo chala gaya, so aap plane aaj chala lijiye. It's just not possible, all right. So, now what happens, you require a money, sufficient cash in the company account, bank account, if not in-house cash, you require a cash in the bank account to make these payments. And these fellows, these receivers of money won't wait for you to get the payment 2 months later and then I will draw my salary. Mera sangsar kaise chalega? This is where working capital comes. It is not fixed capital investment that you are constructing a plant, where the return can take 10 years to come. If the working capital starts the day you start manufacturing, construction of a plant, forget about running the business. You have to pay the, suppose the building is coming up, the wages of the workers are not paid after the building has been completed. They are paid on a daily basis, in fact, daily basis, not even monthly. Here, there is a lot of daily wage workers. So, IIT Kanpur requires working capital, or the contractor requires working capital to make the payments. So, here the normal thing is the working capital, the traditional method has been companies, corporate companies or non-corporate companies would arrange working capital requirements through an extensive process with the banks. So, banks are famous for providing working capital, but often what happens, there is an upper limit to the amount of working capital a company can withdraw or draw from a bank, a short term loan, and therefore, often they would go to the market to borrow additional working capital, and CP is a typical instrument where this kind of short term funds are borrowed. 6 महीने बाद एक बड़ा large amount I am due, but this 6 months I am in trouble. So, I borrow money for 6 months at an interest rate as low as possible, and 6 months later when I get the money I repay it, pay it back. So, CPs have essentially diversified the short term borrowings of companies, and remember CPs cannot be floated by the non-corporate sector, it is a corporate sector financial instrument. If the company has PVT Ltd or PUB Ltd written after them, then only they can do that. The retail outlet or the restaurant cannot sell CP. So, CPs are sold only by the corporate world, corporate companies which have private limited or public limited written after the name. All right? Okay. So, these are usance promissory notes, that is, this money would be repaid at a future date at an interest, you sell them and you get the cash. Now, who can buy CP? I am coming to that. And when you sell CPs, they are not usually secured. You cannot sell CP by keeping some valuables as a mortgage. You sell CPs like any commercial bond. So, therefore, the point that emerges, can all corporate companies sell CPs? No. So, you require a license to sell CP also, and these are the issues I am coming to that. They are usually in India, what is happening, that the corporate world, which is a software company or a manufacturing company, are not only selling CPs, but also financial companies also sell CPs. They are also public limited or private limited, some financial company. They require short term funds, they can also sell CP. And who can buy CP, which is called who can invest in CP? Anybody can buy CP. CPs can be bought by an individual. I can go and buy CP. Another corporate company can buy CP. Even non-resident Indians can invest in, say, Tata is selling CP, or Birla is selling CP, or Larsen and Toubro selling CP. Non-resident Indians, the way they invest in share market, they are very free to even invest in CPs. So, anybody can invest in CP, all right, and these days all corporate companies can sell CPs. And the last point that I want to mention before I come to some guidelines, who can sell CP? Anybody, not all corporate companies are allowed to sell CP. There are some guidelines, and these guidelines are given by RBI, because RBI is the boss of the monetary sector. This is the last point I want to mention. These are often languages used: freely transferable and negotiable. Freely transferable and negotiable. What does it mean? There are instruments which are freely transferable, often written in italics, and negotiable. That means, very simple, that means that they can develop second-hand market, secondary market any time. I bought the CP, which is say 4 months old. I will get the money back in 4 months. After 1 month, I need cash now. I can go and sell it in the secondary market. So, they are freely transferable. The ownership can transfer from me to you, and I can sell it to you, and that rate at which I would sell, the interest rate or whatever price, all right, is negotiable. We too can negotiate that. Nobody stops me from having a market determined interest rate and the price or whatever of that instrument. That means they can develop a secondary market. It is not that if I buy it, I have to sit on it till it reaches maturity, and then I will get back my money and the interest income. It is not like that at all. I can sell it. So, you can develop a secondary market. In fact, RBI wants CP to have a good secondary market. It has not developed well. So, I will tell you some of the reasons why. Now, what I have said up to this point, if it is okay, now let me go into the famous economic survey 1997-98. I found this. I have the economic survey with me, probably 97-98. There are very specific RBI guidelines which were spelled out and reported in the economic survey, and it took some measures, reforms, etc. RBI with respect to the various money markets. Now, let me tell you this guideline of 97-98, then I would tell you what are the small changes that have taken place recently, because 97-98 is how much? 15 years back. So, 14-15 years back. So, let me tell you the main guidelines which were there with respect to the CP market, RBI guidelines, and then I will tell you what small changes that have taken place. First of all, it said that a company, corporate companies trying to sell CP, then the net worth of the company should not be less than 4 crores. I have to explain this. RBI 1997-98 guidelines one, net worth greater than equal to rupees 4 crores. Rupees 4 crores. Now, what is net worth? These are financial variables that you may learn if you take a management course or something, or a finance course or whatever. Net worth of a company can be calculated using simple arithmetic. What it essentially means is, when a company is floated, it announces how much of paid up capital, equity capital it will have. Net worth, how much of paid up capital it will have, or it has if it has already floated and collected. So, net worth is equal to paid up capital net worth is equal to paid up capital. Paid up capital is essentially consists of the equity capital that the company has. And what is the equity capital? It has shown how much shares it has sold, or it has to also, in case of paid up capital, it has to announce also at the time of registration how much of equity capital you would like to have. So, it consists of paid up equity capital, and then it sells shares to get that capital, all right, equity capital. So, paid up capital is nothing but announced equity capital of a company, but net worth is just not paid up capital of the company, it also includes reserves and surpluses. Reserves and surpluses is a more difficult, more complex concept. Reserves and surpluses, both the words are used, are essentially the retained earnings of the company from the past. What are retained earnings? The part of the profit that they did not pay either as taxes or as dividends, but are lying with them, like savings, corporate savings. So, reserves and surpluses, they usually put reserves and surpluses in various heads. They have something called revenue reserve, they have something called capital reserves, and all kind of things, all right. So, I need not go into that. Reserves and surpluses essentially consist of all money that it has with itself from retained earnings, etc., that they can use for various things. They can use for reinvestment, they can use for all sorts of things as their own money. So, net worth of a company is essentially how much money it has as equity capital, which is share capital, all right. Total share capital value of a company can always be calculated, how many shares they have sold. They are calculated most probably at face value, and then how much of reserves and surpluses it has. So, what RBI said, a company has to have minimum of 4 crores of net worth if it has to sell CP. First point. Second, this is a very difficult point. This was withdrawn later, which CP sellers complained a lot. At the same time, it said working capital limit should not be less than 4 crores. This is also very interesting. What you are saying, what RBI is saying, that the working capital that you have arranged with the banks that they will give you, what they do is that bank announces the maximum they will give you as working capital, giving you financial standing and type of business you do, and your habits in terms of returning money, etc., etc. This money, working capital, is a sanctioned loan which is not always used by the company. Company would come and borrow against it or under it if they need the cash, and this sets the working capital limit for a company, all right. Often banks have often companies have working capital limits, sum total of 3 banks which they have contacted, and all of them together have agreed upon that this is the amount of money that you can borrow, which is called consortium banking. You can borrow for working capital purposes. So, what RBI is saying should not be less than 4 crores. That means, the company is have substantial business to run. 4 crores means there are some labor and other costs for which working capital can exceed 4 crores. So, should not be less than 4 crores. Next, then it said, this is where the trouble started with CP market. They said RBI, the CPs can be issued up to a maximum of 75% of the working capital limit. That is, if 4 crores is the working capital limit for a company, it can sell CPs, maximum amount will be 3 crores, 75% of it. So, the total amount of CP that they can sell to raise short term funds will be 75% of the working capital limit. Then what they said? They said a tremendous clause here, which I am going to just utter and not mention here, is as soon as you sell CPs worth 75%, suppose you have sold 75% of your working capital limit as CPs, say 3 crores, some company A's working capital limit is 4 crores. It has sold CPs worth 3 crores. Immediately the working capital limit that was sanctioned by the banks would be lowered by 3 crores. That means, it did not give the corporate companies to use them as alternative in that sense. If you have sold CP of 3 crores, now your working capital limit will become, after you have sold it, till that CP matures, will be 1 crore only. That means, the total amount of working capital they can borrow either from the CP market, either from the banks, or a combination of banks and CP is still 4 crores. इधर में झंझट शुरू हो गया. This was the famous guidelines 1997-98 of RBI, that if you borrow through CP market, your working capital limit would immediately lowered by that amount that you have borrowed, until that CP matures, and then it will be raised again. देखो, and I will tell you, this is where trouble started for it. This clause of that working capital limit would be a flexible thing depending upon how much CP you have bought, and the 75% of the working capital can be floated, can be used for CP borrowing, were delinked in 2000-2001. That economic survey I found that financial year. They were finally delinked because the companies were screaming that you are not giving us any additional room to get working capital. Bank तो इतना दे या उसके ज़्यादा देंगे नहीं, हमको और ज़रूरी है. That's why we are going to the CP market. But if you make that to substitute relationship, all right, not complementary, substitute relationship, then I don't benefit from the CP market. तो बैंक जो दे रहा है वो आप फिर कोशिश यार इतना झंझट करके CP सेल के अनाउंस करो, बायर पकड़ो, क्या ज़रूरी है? वर्किंग कैपिटल जो बैंक दिया वही तो हमको मिलेगा. So, CP market wasn't developing at all because of this clause. It was delinked only 4 years later or 2-3 years later, 2000-2001 financial year. In that economic survey I found it was delinked. Clear? Okay. Now, if you meet these criteria, particularly these 3 criteria, later it was delinked, then it announced that RBI would automatically grant permission if you can show these things, provided, one more thing I have to tell you, provided you get a minimum credit rating done. Last point. the minimum credit rating has to be done by a credit rating agency. What is credit rating? You submit a fee, you go to an organization like CRISIL or somebody, or ICRA, Investment Information and Credit Rating Agency of India Limited, and say, do a credit rating of my company. So, they will ask for all sorts of information, past 10 years, 5 years, profit and loss account, balance sheet data, what kind of goods I sell, what kind of money I borrowed, debt market may, how much paid up capital I have, what is the net worth. There are many variables, financial variables, they are called financial variables of a company. If you open a balance sheet, you will see that. What are the assets to liability ratios, all sorts of things they will check, and then they give a credit rate like a grade we give you, A, B, C, D. So, there is some minimum credit rating that you need to get. In my notes, it is saying I do not really know the meaning of that credit. From CRISIL, if you get the credit rating, it should be P2, and from ICRA, if you get the credit rating done, it should be A2. There is some credit rating, some grade. So, if it is P2 from CRISIL or A2 from ICRA, ICRA, okay, now you are free to sell CP. Basic story I am telling you, the main story, okay, a lot more rules and regulations. Now, then after that, how is CP sold? CPs are sold as discount bonds. Do you remember discount bonds? They are sold at a discount, and when they mature, that discount rate is the interest rate. You get back the entire money, which is the face value of the CP. CPs are sold like just like discount bonds. And whoever is the holder of the CP at maturity, if he places it, he gets back the full money. So, it can change hand. It started with me, I bought it, then I gave to him, he gave to her, she sold it again. There may be 10 hands, it has circulated in 4 months. Now, whoever is the last carrier at the time of maturity will give it to the company, and the company is supposed to pay the face value, just like a discount bond. It is sold, CPs. All right. And we are running out of time, so I would not rush. I would just mention 1 or 2 more points. Every share certificate has a value, so far I know 10 rupees. Every share certificate is a 10 rupees, but the 10 rupee wala may be selling at a premium 240 rupees. There is a reason why it happens, I told you. Company is so good, but on 10 rupees, if they buy, the amount of dividends they will get in the lifetime of the share will far exceed the price they are paying now. Achha. Now, the minimum denomination, it is called, the minimum denomination of a CP is 5 lakhs. So, one CP certificate has 5 lakhs written on it, and the minimum size of an issue when a company is selling some CPs, that is called an issue. The minimum size of an issue to one investor, any one person can buy, is 25 lakhs. That means what? If I had to buy a CP, invest in CP market, all right, I have to buy a minimum of 5 CPs, because each CP is worth 5 lakhs, the face value, and 25 lakhs I have to buy, which means 5 into 5. So, I was not given the freedom to buy 1 CP or 2 CP. If I am investing in it, I have to buy a minimum of 5 CPs. Now, you can see this must have been a problem for small investors. I can invest in 1 CP, good company. I do not have 25 lakhs, I can invest 5 lakhs maybe. So, only companies were buying it then, who has lot of cash, or banks can buy the CPs, or financial organizations who have that amount of excess cash. And therefore, you can see that the CPs are sold in multiples of 5 lakhs, because minimum is issue size to one investor is 25 lakhs, and each CP is 5 lakhs. That means, you can go into multiple of that. This is just like the mutual fund certificates, UTI units, same thing. Each unit is worth 10 rupees or 100 rupees, something like that. Now, you can buy multiples of that. 10 units de do humko. That means 10 into 10 I am investing. But you know what happened? These things have changed. And the last point I want to mention, 1997-98 guidelines, which changed later. The maturity period was from 91 days, which is 3 months, to 6 months. The CP maturity period varied between 91 days to 6 months. So, 6 months was the upper limit. 6 महीने के अंदर CP mature कर जाते हैं. So, it's a money market instrument. But you know what happened in the July 2000, that is 2000-2001 economic survey I found, that Government of India smartened up. They realized there are too many stringent clauses here. They made the minimum issue size of CP to 5 lakhs. That means, if anybody wants to invest and buy only one CP, he can buy, not 5 CPs anymore. They relaxed that 2 years later, 3 years later, they relaxed it. And the maturity period became very interesting. It was no longer from 3 months or 91 days to 6 months, it became from 15 days, unbelievable, 15 days to 1 year maximum. So, it is a huge range of the maturity flexibility given to the CP market, massive range. It can be 15 days, that means a fortnight, it can be 1 month, it can be 2 months, it can be 6 months, it can at most be 1 year CP market. So, this is an instrument, it is good you are coming to know these things, because tomorrow when you enter the world, the job you will have, they will be like bread and butter every day for you. You will be dealing with them all the time. But for the time being is new, but I am glad I am telling you this, because it will help you. But there is something more to be said about CP. So, what I am planning to do, can I talk about this enough tomorrow?